Hello, fellow YouTubers. In this video, I'm going to look at, is it worth it changing my biggest holding, or should I remain the course? All right, guys. So I was listening to the Paul Merriman podcast that came out yesterday, and they show let's go to paulmerriman.com. They show the ultimate buy and hold portfolio that has the recommended funds. He's very spread out and very diverse in his funds here. So ultimate buy and hold 2019. I somewhat follow this in terms of having more in small cap value than non. So if you look at portfolio number 7, you're putting 10% S&P 500, 10% large cap value, 10% in small cap blend, 10% in small cap value, 10% in REITs, and then the other 50% is essentially the same internationally with 10% emerging markets, right? I'm a little bit higher in the small cap value because it has shown to be one of the preferred in terms of higher asset classes over a very long period of time. When you look at the portfolios that they show here, you'll notice that, let's do recommended here. When they show the different portfolios, here we go, sorry. When you look at the portfolios, you'll see that there's a small cap value fund that they recommend. That is slyv. This is the Spider S&P 600 small cap value fund. If you go to Morningstar and type in slyv, it does have 5-star on Morningstar. The SEC dividend yield is 1.89%. The expense ratio is only 0.15%, so it's very low. And they are, when you look at the chart under portfolio tab, you'll see the 9 boxes of large, small value blend, and it's the one in blue right here. So it's relatively smaller companies and definitely value oriented. Okay. Notice the Russell 2000 index is pretty close to it as well. It's a little bit higher, but a little bit more to the blend side. Okay. Now, there's a new fund that Fidelity came out with literally a few months ago. It's a Fidelity Small Cap Value Index Fund. What key thing that I noticed is the expense ratio. It is 0.05% instead of 0.1%, which is not dramatically different, but could be a factor. I have about $15,000 in it. If I save 0.1% a year, that doesn't make sense. Hold on. 15,001 would be $15 a year that I wouldn't have to pay in fees. So again, not the end of the world. It's something that I need to consider to see, is it worth it to switch or not. Sorry. So the other things I noticed about this, it does follow the Russell 2000 Value Index. Now, the Russell 2000 Index and the S&P 600 Index are different accounts, and they do follow slightly different methodologies. The Russell 2000 essentially takes 2,000 of the smallest companies that are around, and then they change based on price to book value. The S&P 600 Index does look at more metrics, so has to show positive growth within a few years. The S&P 600 has no stocks with share prices below $1, and only 3 below $2, while the Russell 2000 has quite a few with it, 15 and 39 there. You have to have a financial viability component in the S&P 600, so the company's most recent 4 quarters of GAAP earnings need to be positive. However, in the Russell 2000, it doesn't do that methodology. So what I'm going to try to consider is it worth it staying in the current fund that I'm in, which is the S&P 600, is it worth spending the extra expense ratio, or should I change to the Fidelity one? I'm still debating on each issue. I don't think it's really the end of the world in terms of the total returns in the end, but it's something to definitely consider because it is a smaller cost to actually do this fund. So any questions or comments, let me know, and I'll talk to you guys next time.